Hi there, traders. This is Brad Gilbert with the FX Market Insight for Thursday, the 13th of May. All right, now the US CPI numbers did not disappoint. Now we're expecting around 3.6% for the year on year and about 0.2% for the month on month. Now we had massive numbers, right? Normal scheme of things, 4.2% year on year interest, that would result in numerous interest rate hikes, all sorts of things. Obviously, we're in a different environment. The market expecting around 3.6% was thinking, well, it's not going to be enough to get the Fed doing anything. These numbers here do change the picture, right? They change the Fed's outlook. And the market has already started to factor in potential rate hikes as early as late 2022, which is, a couple of years ahead of the Fed. So what the market does, understand the numbers come out, the market as a whole judges what the impact of that is, and then they go and it starts to be factored in across bonds, equity markets, currencies, and all these sorts of things. Now, the Fed have already sort of given instructions of what they're going to do, but these numbers are almost beyond their control, right? So they will have to start doing something. We will need verification from the Fed, but that the market is looking at it going, that's what the Fed needs to change, and that's what we're anticipating, and that's where the move comes from. So, we had the non-farm payrolls pushed the dollar down, traded sideways all week, waiting for this CPI number. And then we start to get it higher. So as I was saying, like normal market conditions, right? You get these sort of moves. The numbers themselves warrant something way up here, but it's stalled. The market needs confirmation from the Fed and or the next key macroeconomic data if they're massively through the roof. And we've got retail sales figures coming out in a couple of days, or Friday, I think it is. If they're like above 10%, well, it's a foregone conclusion that the Fed are going to have to get off their backside and start actively managing the economy because there's so much cash out there. People are spending and it's going nuts. Right, so that's what we've got. Now, let's just have a look what's going on in the currencies, and I'll come back and explain the outlook from here. So obviously the dollar, a nice reprieve. We've got trend lines, and the currencies, they are behaving gorgeously around the trend lines. Like dollar Swiss here stalling at that major level there, just below 91 the figure at the trend line itself. Dollar yen has shot the barn, it's gone. We've got a nice resistance line here on dollar CAD to work with. As I said, these numbers are above and beyond what probably the Fed expected. This could be if we see oil fall back to like $60, that's going to put upward pressure on dollar CAD. And with this dollar, initial dollar strength, we could see easily a couple hundred points here or 150 to the top side, just a minor correction there in dollar CAD. Euro, well, it's traded sideways through this trend line. We've now got support down here around 120.50. Same for sterling, although it hasn't sort of dropped off as much. It's got its own unrealistic economic growth expectations on this vaccine rollout. The Aussie belted down through that pivot point 78.17 through the next support line, which you can see was creating traction, and we're now at 77.20, same as 71.60. So if you aren't used to trend lines, and I haven't drawn these trend lines in now, these have been there all week, you can see how important and how technical analysis works, right? The key to what we need to do now is, where's the next move coming from? Is this move that we've seen, is that just the start of it, or is that it, right? So what you need to do is really connect the dots. And this is where we're going to be looking back down towards the US retail sales figures as a key guidance as to if the dollar keeps going or not. Now, strong retail sales, it goes. Weak retails, it falls. It's coming down to that normal market's vanilla interpretation of what's going on. So our job here is to gauge momentum and where direction's coming from. Now, the Treasuries, I just flick over to here, have rallied through the roof, right? The long-dated Treasuries, I mean, look at these 30 years, 2.415. It's massive, right? So that puts massive downward pressure on equity markets. The anticipation of earlier interest rate hikes in the States, higher rates, lower equity markets, right? Which creates a classic risk-on scenario. The dollar block, euro, sterling, Aussie, Kiwi falling, and the dollar rallying, right? This is the early stage of this move. The market is sort of still scratching its head going, are these numbers real or is it seasonal? So that's what we're looking for. If it's confirmation that, you know what, these numbers are real, well, then the Fed's going to have to start really doing something, being very proactive in managing the economy, because interest rates can get out of control like we saw in the late 80s. We're up around 17, 20%. They don't want that scenario. So keep an eye on the Treasury yields. But right now, like we're coming to the Asian session, just to understand the cycle of the data, right? Actually, while I'm on this page, before I flick back, is volatility index, right? Which you can imagine, and that measures the volatility on, say, the equity markets. If, with this massive data, it sends a huge scare through the markets. Of course, volatility is going to spike on that sort of scenario. And this could even get bigger, right? So just keep an eye on that. It's a good precursor to nervousness in the market, volatility as well. That's something to keep a very close eye on. So now, I was going to show you on the charts. So what we're looking for is basically to connect the dots. So, okay, this is where I was coming back to. So the markets, right? So if I just bring you back to this page, excuse me. If you just have a look at the US equity futures, right? They're up a little bit, right? It's what that is. It's the daily cyclical correction. Okay, the US North American session got hammered. Of course, there's a bit of profit taking. It loses momentum. So the equity markets come back a bit. Now, it doesn't mean they're going to correct, but what you see on the currencies, it should be similar, is you get the initial move down, you get a little bit of a correction in the Asian market, and then if it's a real move, you get the follow-on effect during that European North American session. So that's what I'm expecting to happen. That's what the equity markets, the equity futures are telling us. By no means is it a correction. It's just a normal cycle. The session where the data came out, that's gone. We've lost that initial momentum now. There's a bit of a correction as people take a bit of cash off the table, and then we'll see if it goes again. As I said, the best thing to do is focus on the levels that are close and work out if we've got enough momentum to kick them into gear, right? And this is where data from the independent countries, and what I mean by that is non-US countries like New Zealand, Australia, UK, and Europe, okay, Germany. If we start to get weak data on those countries now, it supports the move down, and that's where we get the big correction, right? So the best thing is, like, coming from the CPI, huge anticipation. All we wanted was massively strong or massively weak. We get the market working, and we can pick it off. And that's what we've got. It's not the ideal weak number because the dollar would have absolutely crashed. That's like, it's not in a situation where the dollar is absolutely screaming to the top side just yet, but we are one or two pieces of data away from that happening, especially if the Fed come out now and go, you know what, maybe we got a little bit wrong and we are going to have to do something. You can expect the dollar to rally through the roof on that scenario. And especially when it's been right down here, poked just below 90, the figure on the dollar index, it's sort of almost stretched to the downside and now ready to ricochet to the top. So we've got to keep an eye on that. Right now, I'd be going with this short-term dollar strength, okay? In saying that, let me just show you this chart, because when you widen it out, you get a bit of scope of what's actually happening, right? So you can see, right, where's my little pen? Okay, you can see trading sideways and we get this correction higher. But you know what? In the scheme of things, since sort of March, the end of March, the dollar index has been trading down, right? So we did have this slight correction. It's now down. We need to break through 91, the figure, for people to start standing up and going, you know what? The dollar is going up, right? Until that happens, the dollar, this is a little pause in the cycle. It could still be down. We need to see the next level of data, get some information from the Fed to tell us if it's going up or down. Then we'll have the answers. Then you can trade. Until then, right, I know this trend. Let me just clear that screen. I know this sort of short, I guess it's really short to medium term trend is down. This is the key level. If anything, the euphoria from these numbers, until I'm told otherwise, tells me to buy dollars, right? Not at these particular levels, but if I get confirmation, I'm looking to buy. So maybe on a dip short term back towards 90.40 on the index, or above 91 makes sense. right? And if the Fed comes out and says, you know what, they've got to be careful, and they say, nah, that's seasonal. We're not interested in 4.2%. Well, then the dollar should roll over again. But that creates a situation where the Fed, if they back themselves into a corner and the numbers keep going up and up and up, they look like fools. They'll lose control of the market, and that is another major issue, because then it's just loose as a goose. Anyway, we'll cross that bridge when we come to it. If anything, it's exciting times, right? We've got, and when you come in and start charting the equity markets, start focusing on those long-term support trend lines. This thing's just been going up and up and up, right? The interest rate hikes have to come at some stage. If they come sooner than later, equities are going to get pummeled, right? We haven't got Donald Trump there just throwing his two bob in to try and keep the equity markets going up. No, this will be a natural correction, and it will be dramatic. All right, that's where the cash is going to be. All right, guys, that's it for me. As I said, exciting times. Focus on where direction's coming from. Short-term dollar up. That's got to be the go just at the moment until we get something else to tell us otherwise. All right, guys, good luck. Cheerio.